Assalamualaikum and greetings to everyone. So for the case study question, let us begin with plantation division. Question A asks, explain the distinction between bearer plants and biological asset in the context of a palm oil plantation with reference to the applicable MFRS standard. The first question being that why are all palm trees classified under MFRS 116 rather than MFRS 141, while the FFB, the fresh fruit branches growing on them, remain within the scope of MFRS 141. Next is what measurement basis applies to each of it and why the distinction matters for faithful representation of company's A financial position. First of all, we need to distinguish between all palm trees and the FFB, the fresh fruit branches growing on them. So all palm trees are classified as bearer plant under MFRS 116 PPE, whereas for FFB, it is classified as a biological asset under MFRS 141 agriculture. So why the differences? So let us think the oil palm tree as a biological factory machine, where its sole purpose is actually to produce agricultural output or the byproduct over multiple period of time, whereas, or we can say that the tree itself is not harvested or sold as agricultural produce, but it is our asset. That's why it's fall under MFRS 116 PPE. Whereas for the FFB actually is an agricultural produce or actual produce or byproduct that undergoes active biological transformation before it being harvested, which is why we've placed it firmly under MFRS 141. And this brings us to its measurement basis. So under MFRS 116 PPE, the bearer plant are carried at cost less accumulated depreciation, whereas under MFRS 141 agriculture, the FFB should be measured at fair value less cost to sell, the FVLCTS, at the point of its harvest, with any changes should be recognized in profit or loss. Finally, why does this matters for faithful representation? First, it perfectly reflects our economic substance. So the tree is actually a long-term productive asset, we can say. So it loses economic life and value over the time, which is hence why we did the depreciation. On the other hand, the FFB is actually, we can say, a dynamic asset, we can say, which is why the value actually shift or changes with its biological growth and market price fluctuation. So treating all of these differently ensures that our financial statement, the financial statement accurately reflects the true nature, risk and the value of company's A plantation operation.
Good day everyone. For question 1B, I will evaluate whether the CFO's valuation achieved faithful representation under the ISB conceptual framework. In my opinion, the CFO approach does not achieve faithful representation. Although MFRS 141 requires biological assets to be measured at fair value less cost to sell, applying the full market price of 650 ringgit per tonne for harvested FFB directly to immature FFB is inappropriate. Firstly, this approach compromises the qualitative characteristic of faithful representations. It is not complete because it ignores biological transformation risks and uncertainty. It is not neutral because the valuation is intended to increase the company's reported asset and profit to attract potential investors. It is also not free from error because the valuation assumes immature FFB has the same value as harvested FFB. Secondly, the CFO focuses only on the form, which is the market price of harvested FFB. However, the economic substance is different because immature FFB are still undergoing biological transformations, cannot yet be harvested, and are exposed to risks that may affect their final yield and value. A more faithful valuation should estimate fair value by considering the maturity stage, expected yield, biological risk, and uncertainty before determining the fair value less cost to sell. Therefore, the CFO's method to overstates both the biological assets and profit, resulting in financial statements that do not faithfully represent the company's actual financial position. Thank you.
Hi, I'm Jia Ying. Now, I will explain about the ethical responsibilities of an accountant in financial reporting. This is the third question. As a junior accountant in Company A's finance team, you have been instructed by the CFO to prepare the fair value workings for the immature FFB using the full market price without any adjustment. You are aware that the resulting financial statements will be presented to a potential strategic investor. Now I will discuss on three aspects. First of all, the ethical risks, the steps should be taken, and also the professional obligations. First, let's look at the ethical risks. By following the CFO's instruction, I will be breaching the principle of integrity because the valuation does not reflect reality. This undermines faithful representation in the financial statements. There's also the risk of legal liability if investors rely on misleading information. Besides, both the company's and my own professional reputation could be damaged. Finally, this creates a conflict of interest between loyalty to my employer and my duty to uphold ethical standards. Next, the steps I should take. Before raising concerns, I will start with evidence gathering. I will conduct market research to establish the fair value of immature FFP. Then, I will escalate internally, first to my manager, and if unresolved, to the board of directors or audit committee. Throughout this process, I will keep complete documentation of all communication and evidence. If internal channels fail, I may need to consider external reporting to auditors or regulators, while ensuring I comply with whistleblowing protections and confidentiality requirements. Finally, my obligation to external users. As an accountant, I must uphold integrity and ensure financial statements are free from material misstatement. I have a duty of accountability, recognizing that investors and stakeholders rely on accurate data. I must prioritize the public interest over personal or employer gain. And last but not least, I must ensure transparency so that external users can make informed and data-driven decisions. That's all from me. I will pass to another member. Thank you.
So now let's move on to the real estate and property division. So firstly, I'll present the accounting treatment for the three properties owned by the Prime Development Berhad. So for property 1, the corporate and retail tower, the building has a mixed use, which is the 7 leased floors are classified as investment property under MFRS 140 because they generate rental income. The remaining 3 floors are used as the company's headquarters and are classified as PPE under MFRS 116. Since the floor can be sold or leased separately, so they must be accounted for separately. And for property 2, the horizontal land plot is vacant land with an undetermined future use. So under MFRS 140, land that held for future appreciation is classified as investment property. So finally, the property 3 is developed for sale. So it is classified as inventory under MFRS 102. Next, for the measurement, all the 3 properties are initially measured at its cost. So for the lease proportion of property 1 and for property 2, which are classified as investment property, subsequent measurements may follow either the fair value model or the cost model under MFRS 140. So for the owner-occupied portion of property 1, it's follow MFRS 116 using either the cost model or the valuation model. Meanwhile, for the property 3, it is subsequently measured at the lower of cost and naturalizable value under MFRS 102. Finally, the CFO's proposal to classify all 3 properties as investment property under MFRS 140 is inappropriate because it violates the qualitative characteristic of faithful representations. Although the property 2 may qualify as investment property, property 1 contains owner-occupied floors that must be accounted for under MFRS 116, while property 3 is inventory under MFRS 102. Therefore, applying the fair value model to all 3 properties would not faithfully represent their actual nature. It lacks completeness, neutrality, and is not free from material error.
And now we will look at the first part, which is a part A, which we will do a recognition decision for MFRS 137 for the food manufacturing division. For the first product we call cost, our decision is to recognize it as a provision. Because first, they are a present obligation because they are public announcement made before the financial statement were authorized. Second, we have a probability outflow of 70% above the 50% rate, and we have a best estimate of 1 million ringgit. Next, for the consumer lawsuit, we will disclose it as a contingent liability because there are no present obligation. The legal counsel told us that we will only lose 30%, and consequently, no provision is recognized on the balance sheet, and this situation will only be disclosed within our financial statement notes. That's all for part A. Moving on to the second part, which is part B, which we will see how uncertainty will directly influence financial reporting decision under MFRS 137. First, we have to know that uncertainty dictates recognition. As we can see on the right side of the image, we will follow a probability scale for the contingent liability. If it's only a possible 5 to 50%, it will only be go to note disclosure instead of financial position. But if it above 50% into a probable territory, it will only recognize as a provision. This is why the two scenarios are treated differently. For the product recall cost, it will treat it as a provision because it goes above 50%, which is 70%. But for the consumer lawsuit, it is only under 50%, which is 30%. Second, uncertainty heavily influenced measurement. When dealing with a single obligation like a product recall cost under MFRS 137, it told us that we pinpoint the most likely outcome rather than using range as a whole, which is why we settled on exactly 1 million ringgit. If we were managing a large population of independent claims instead, we will use an expected value model by weighting all potential outcomes by their relative probability. That's all for me. Thank you.